I don't remember anybody telling me we're going to have the worst recession since the Depression. What you learn from history is the market goes down. It goes down a lot. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks.
What's up, everybody? Doriso here for another episode. Recently, the stock market has crashed. Volatility levels are very high, and discussions about a recession or even a depression have hit news headlines. The man on your screen is Peter Lynch. He is known as one of the greatest investors of all time. He was the manager of the Magellan Fund between 1977 and 1990. During his 13-year tenure, assets under management increased from $18 million to $14 billion. Lynch was a legendary stock picker and averaged a 29.2% annual return, which was more than double the performance of the S&P 500 during that time. Peter Lynch gave a lecture back in 1994 with timeless tips for investors looking to multiply their money in the stock market. If you're like me, I always like to learn from the best, especially multi-millionaires with tons of knowledge. During the lecture, Lynch discussed his core investing principles. This episode will include 11 tips from Peter Lynch and his viewpoints on recession headlines and concerns about high levels of volatility in the stock market. Lynch's secrets to success can be applied at any time in the stock market. Let's get straight to it. Tip number 1, market volatility is terrific and a great opportunity for investors, but not good for the public. Market volatility is when the stock market rises and falls more than 1% over a sustained period of time. Let's listen to Peter Lynch's answer back in 1994 explaining why value investors should embrace volatility. He talks about his investment in Taco Bell and the fact that markets will go up and down.
Are you concerned about the volatility in the financial markets today? Do you think something needs to be done to reduce it?
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept onto it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola. And I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur. The markets will continue to have these ups and downs. I think that's a great opportunity.
If you're looking to multiply your money by 29% or higher each year, just like Peter Lynch did, then click that like button. I'm interested to see how high that like counter will go. On to tip 2. Investing in the stock market is not that complicated. No one can predict the stock market or economy. In this clip, Lynch explains no one told him about a recession.
Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate, with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read. I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. So what I'm trying to tell you, it'd be very useful to know what the stock market is going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rate's going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it.
Next up, tip number 3. Facts are relevant to investing. Economic predictions are a total waste. In this clip, Peter Lynch explains the facts he looks for in the auto industry, hotel industry, chemical industry, and the list goes on. Let's listen in.
When I own auto stocks, I want to know what's happening to used car prices. When used car prices are going up, it's a very good indicator. When I own hotel stocks, I want to know hotel occupancy stuff. When I own chemical stocks, I want to know what's happening to the price of ethylene. These are facts. If aluminum inventories go down 5 straight months, that's relevant. I can deal with that. Home affordability, I want to know about when I own Fannie Mae or I own a housing stock. These are facts. They're economic facts and it's economic predictions. And economic predictions are a total waste.
We sure are moving along. Tip number 4, learn from history. The market goes down. Take advantage of market volatility and stock declines by investing in companies you understand. Let's listen to Peter Lynch.
But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine. You're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own.
On to tip number 5, patience. You have plenty of time when you have a long-term outlook on investing. Lynch explains there shouldn't be a rush in buying a stock. He goes over 2 investment opportunities in Walmart and Microsoft back in the day. Let's listen.
Another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor. You're not sure this Walmart can make it. You want to check. You see them operate in small towns. You're afraid they can only make it in 7 or 8 states. You want to wait till they go to more states. You keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money. But you could have waited 10 years after Walmart went public and made over 30 times your money. You could have waited 3 years after Microsoft went public and made 10 times your money. Now, if you knew something about software, I know nothing about software. If you knew something about software, you would have said, these guys have it. I don't care who's going to win, Compaq, IBM. I know who's going to win Japanese computers. I know Microsoft, MS-DOS is the right thing. You could have bought Microsoft. Again, I'm repeating myself. Stocks are not a lottery ticket. There's a company behind every stock. And you can just watch it. You have plenty of time. People are in an amazing rush to purchase a security. They're out of breath when they call up. You don't need to do this.
On to tip 6. Know exactly what you're buying and why you're buying a stock at all times. Let's see what Peter Lynch has to say.
But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16 and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do?
Tip number 7. Price discounts do not mean you should buy a stock. Here's a brief rundown of a $3 stock, and Lynch explains price alone doesn't mean you should buy it. Let's listen in.
Here's another one you hear all the time. It's $3. How much can I lose? I've had people call me up saying, I'm thinking of buying this stock at 3. How much can I lose? Well, again, you may need a piece of paper for this, but if you put if you put $20,000 in a stock at 50, or your neighbor put $20,000 at 50 into the stock, and you put $20,000 in at 3, and it goes to 0, you lose exactly the same amount of money. Everything. And people say it's 3. How much can I lose? Well, if you put $1 million on it, you can lose $1 million. Just the fact that stock, this may be a reason to research a stock. The fact that stock is 3 down from 100 doesn't mean you should buy it.
We sure are moving along. Tip number 8. You don't have to be right with every stock investment. If you put $1,000 in a stock, all you could lose is $1,000. But if you're right, You can make $5,000, $10,000, $20,000, and it just goes on. Lynch goes over a story that he was playing golf during the 1987 stock market crash, and there was nothing he could do at that time. He then explains when you're right on an investment, the stock market allows you to multiply your money on the upside. Peter, what do you got to say?
There's nothing I could do. I mean, just nothing I could do about it. But I think my shareholders, they called up and they said, well, what's Lynch doing? They said, well, he's on the 6th hole and he's even par up to now, but he's in a trap. This could be a triple bogey here. This could be a big inning. And I don't think that's exactly what they want to hear. So I could do something about this damn thing. So I came back home and suffered with everybody else. And fortunately, I was very consistent. The market went down. When I ran Magellan on 13 years, the market went down 9 times. And every time the market went down, Magellan went down. I was 9 for 9. And, because it's very important. This is another one of these numbers you ought to write down. If you put $1,000 in a stock, all you can lose is 1,000. I've done that several times. And but if you're right, you can make 5,000, 10,000, 20,000. So this business, you don't have to be right 1 out of 2 times. You can be right 1 out of 4. It's a long time. The times you're right, you know the company's doing well, you know they're doing a great job, and you add to it, or at least you don't sell it, which is a terrible tragedy. So you can make more money on the upside. So I just wrote those out.
Tip 9. There's always something to worry about. In this clip, Lynch goes over concerns of war, oil prices, debt loads, and all lead to predictions of the next depression or Great Depression, or even the big ones coming. Let's listen in.
There's always something to worry about. If you own stocks, there's always something to worry about. You can't get away from it. What happens in the 50s, people were worried about the only reason we got out of the Depression was World War II. We got another recession. In the early 50s, they said we're going to go right back into a depression. People worried about a depression in the 50s, and they worried about nuclear war. I mean, back then, the little warheads they had then, they couldn't blow up McLean, West Virginia, or McLean, Virginia, or Charlestown. Now, all these countries that end in STAN, there's 9 of these STAN countries that have come out of Russia. They all have enough warheads to blow the world up, and no one worries about it. When I was a kid, people were building fallout shelters, and we used to have this civil defense drill. Remember this one in high school? You get under your desk. I never thought even then that was a particularly good thing to do. They'd blow with some people in a hat would all get under our desk. But in the 50s, people wouldn't buy stocks, except for the 80s. The 50s was the best decade, the century of the stock market. And people wouldn't buy stocks in the 50s because they're worried about nuclear war and they're worried about depression. Then people, remember when oil went from 4 to 40 and it was going to go to 100 and we're going to have a depression? Remember that one? Well, about 3 years later, the same experts, now higher paid, oil's now at 10, they said it was going to go to 4 and we're going to have a depression. And then the Japanese, remember how the Japanese were going to own the world? Remember that one? And that we're going to have a depression? And then about 2 years later, we're all worried about Japan collapsing. And this is the most absurd thing I've ever heard. There's a company with a 20% savings rate, incredible workforce, incredible productivity, and people are saying we're going to have a depression because Japan's going to collapse. And they had, it's unbelievable. I mean, the LDC debt. Remember the LDC debt? Remember that one? All these countries, all Chase had lent their net worth to Brazil, Chile, Peru, and all these other countries, and so and all the other countries. And LD said they were not going to pay it back, and we're going to have a depression. It always ends and we're going to have a depression, or the Great Depression. We're going to have the Great Depression. I never could quite understand that adjective in front of depression, but the Great Depression, or the big one. The big one's coming.
We're moving along. Tip number 10. When it comes to investing in the stock market, your stomach is more important than your brain. Lynch explains there will always be something to worry about. You need to cut it all out and own good companies or turnarounds, and you'll do well. Lynch explains there will always be something to worry about. You need to cut it all out and own good companies or turnarounds, and you'll do well. Let's listen in.
So there's always something to worry about, and the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8, get reasonably close to 16, that's the only level of math you need to know. All you have to know is you're going to see it's always going to be scary. There's going to be always something to worry about. You just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well.
And last but not least, tip 11. Long term, the stock market's a very good place to be. Everybody in the world is a long-term investor until the market goes down. Here's his response to what am I going to do when the stock market goes down? You will be very pleased in 10, 20, 30 years if you continue to invest more and more every single year.
This is important whether you're investing for a 4-year-old, a 14-year-old, or a 74-year-old. You have to say, what am I going to do when the market goes down? Because I've had audiences like this, larger audiences, and I'll say, how many people in the room are short-term investors? I've never had anybody ever raise their hand. I mean, everybody in the world is a long-term investor until the market goes down. And like in I remember 1990. 1990 was so much scarier than 87. 87, the market just fell down. And you call up companies that our business is terrific. We're about to announce a stock buyback. We're already buying back our stock. Business is great, and we can't figure this out. But in 1990, you had Kuwait invaded. You had the banking system really on the ropes. I mean, really close. You call up a company and they said the business was slowing down. We sent 500,000 troops to Saudi, and we were about to fight what people thought was the, remember this, it was the 4th largest army in the world, and they were the toughest army in the world, and this was going to be a terrible war, and that we ought to sit them out. Remember the theory, big theory, there's a lot of people in this city saying, we had to wait them out. You know, we'd still be waiting there at 120 degrees with our 500,000 people. But that was an ugly time, and that was very scary. And the public stood up. Some people learned from 87, and they stood throughout that and said, I'm confident about the next 5, 10, 15 years of this country, and they hung in there. So I would say if you want to buy a small growth fund, or you want to buy a balanced fund that's part bonds and part stocks, you put so much money in, put more in every year, you'll be very pleased in 10, 20, 30 years. Stocks will beat the hell out of money markets. They can beat the hell out of bonds.
And there you have it, 11 tips that I will be applying during a recession and extreme levels of stock market volatility. As I do in every episode, here's a quick portfolio update. If you're new, I created this channel to consistently track, share, and document one of my stock portfolios and the journey from $0 to infinity. I've been investing for 10 years now, and I believe investing in the stock market is one of the easiest paths to financial independence. I mark my progress in each YouTube thumbnail. Currently, we're up to a little over $2,900, which is still very small since I've only been depositing little money at this time. The amount of deposits will definitely ramp up as we continue on with these episodes. By the time you know it, you'll notice my thumbnail balance will be much higher in the future than it is today. Maybe you'll subscribe and join in on the fun when I hit your number. It's just a matter of time. To recap, I currently own stock in Apple, Fiverr International, Penn National Gaming, and Starbucks. I have discussed my reasoning and mindset for buying these 4 stocks in previous episodes, and I will continue to do so in future episodes. I can't believe we're already up to episode 25. We sure are moving along. As always, do your own research prior to making any investments. Read the disclaimer on your screen fully. Remember, all opinions in this episode are mine and mine alone. I'm not a financial advisor, and this video is for entertainment and informational purposes only. Maybe I didn't earn your subscription with this episode, but there's always next episode. It's free to subscribe and follow me on Instagram while you're at it. For all those that made it to the end, I'll be choosing the best comment in the comment section below for this video, and I will provide a shout out at the end of next episode. So look out for it. I appreciate your time for this episode. Thanks for watching. Let's keep building from 0 to infinity. Peace.